In Chapter 5, we're going to be discussing gross income, so that first component of our tax formula, and specific exclusions from gross income. So we're going to apply the concept of what we call realization, discuss the distinctions between the various sources of income, including income from services and property, and we'll apply basic income exclusion provisions to compute gross income. So let's get right into it. Gross income. So taxpayers must report realized and recognized income on their tax return for the year. Right in the tax code, it says income is included from any source unless specifically excluded or deferred within the code. Excluded means never taxed. Deferred means it may be income now, but it's taxed later. So the definition of gross income, again, 61A, Code Section 61A, gross income means all income from whatever source derived. The reg goes on to explain it further by talking about it includes income realized in any form, whether you receive it in money, you receive property, or you receive services. Taxpayers recognize gross income when they receive an economic benefit, so they get something of value. They realize the income, so it's occurred. There's a sale, there's something, your financial situation changes. And the tax law does not provide for any exclusion or deferral of that item. Again, economic benefit. Borrowed funds are not included in this. Amounts increasing because of values increasing in the world are not included in this. You may feel economically you're better off, but you haven't realized that yet. So borrowed funds aren't included because these are liabilities. These are amounts you have to pay back. So that's when you borrow money, it's not income. Realization principle, again, the taxpayer engages in transaction with another party and it results in a measurable change in property rights. And finally, recognition, it's assumed to be recognized absent a deferral or exclusion provision. So everything's included unless you could find somewhere in the law that excludes it or defers it. Other income concepts, the form of receipt, does it really matter? And the answer is no. It could be in the form of cash, it could be in the form of property, it could be in the form of services. So if you are in a business, for example, years ago, I used to do my nail tax return. So we made a deal. I did her tax return. She did my nails for the same value. So say it was $400. That doesn't mean I don't have $400 of income. Because if she would have paid me instead of doing a barter with her, she would have given me $400 in cash. Instead, she gave me $400 in services. It's the same concept. So I had to recognize 400 of income and she had to recognize 400 of income because she received a service as payment. Another provision you need to keep in mind is the return of capital principle. And it says this: when we have an asset, we pay for it or we may be given it. But all assets have a tax basis, and we'll talk more about this in detail. When we sell an asset, the part of the proceeds or the amount realized up to the cost of the asset are not taxed. It's like you're getting your money back. We call it a return of capital. It's the excess amount that you receive that is taxed. That's the gain. So gain is calculated by taking selling price of the asset minus the tax basis of the asset, because that part of the selling price is not taxed. Any gain, if the result is positive, is taxed. Recovery of amounts previously deducted are included in income. So individuals typically claim deductions in the year they pay them. Sometimes those items that we might have deducted are reimbursed or refunded in a subsequent year. So if we take a tax deduction in one year and get a refund of the item we had deducted or a partial refund, we need to include that as income on the next year's tax return. Okay, so you don't have to redo your tax return. You just have to include it in income in the next year. Last year, Courtney reported $95.50 in itemized deductions. Remember what itemized deductions are? They're personal expenses like medical, state and local income taxes, charitable deductions, and home mortgage interest. Well, last year, when she reported her itemized deductions of $95.50, $3,500 of it was from state income taxes she paid last year. Okay, so the standard deduction last year was $93.50. I think this example goes in too much detail with stuff. Here's what I want you to know. Here's what I want you to know out of this. Since she deducted the $3,500 as a deduction on her tax return, let's say Courtney got a refund when she filed her state income tax return last year of $200. That $200 would be included on Courtney's federal income tax return the year she got that money. Since she took a deduction of $3,500 and she got part of it back, the $200, she has to show that $200 on her federal income tax return. You could take a look through this. I'm not going to get this crazy. Let's move on. When do we recognize income? Well, an individual will generally recognize it according to their accounting method. Most individuals use a calendar year and cash basis. Individuals use cash method. A corporation, some are required to use accrual like we have in financial accounting. So the cash method says you record income the year you receive the cash. You record a deduction the year you pay the deduction. There is a little caveat to the income concept, and that says you've constructively received the income. So you must recognize income in the year you actually receive it or you constructively received it. And what we mean by constructively received it is that you have the right to that cash or that income with no restrictions. So it's just your choice not to take it. For instance, when you have a savings account, the bank puts the interest in your savings account in the year you earn it. You pay income tax on that money in the year you earn it, not when you take the cash out. Why? Because you've constructively received it in the year it was put in your savings account. You had access to it, and there was no restrictions. Okay, so that's what you're looking at. Here's another example. Taxpayer A has a business. Customer gives him a check on 12/31. Taxpayer A chooses to wait and cash the check until January 3rd. What year is that income? Well, taxpayer A could have cashed that on December 31st and received the cash. It was income December 31st, not the day he actually cashed it. Constructive receipt. Now, if there was a restriction, let's say taxpayer A, the customer told him, don't cash that till January 3rd. I don't have any money in my checking account. Then he did not constructively receive it because there was a restriction on it on December 31st. There was no money there. He wouldn't have gotten the cash anyway. So in that case, it wouldn't have been income until he cashed it January 3rd. So that's what they mean by constructive receipt. In addition to determining when taxpayers realize and recognize income, who recognizes it? The first deals with what we call assignment of income. And this went all the way to the Supreme Court. It was Lucas versus Earl or Earl versus Lucas back in the 1930s. And the Supreme Court said this: the fruit or the tree that bears the fruit bears the fruit. So the person who owns the property, performs the service, etc., they recognize the income. And what happened in that case, if I'm recalling it correctly, was that a husband told his employer to make his paychecks out to his wife, and they tried to say that that was the wife's income for tax purposes, when in fact the fruit and the tree concept, the tree was the husband, the one who performed the service, so the income or the fruit from doing the service is his income. When it comes to property, we look at ownership of the property. So you can have someone write your paycheck out to another person, or you can have somebody write the check out when you sell them assets to another person. The way the IRS and the court system looks at it is that you received the income and then gifted it to the other person. So just by writing out the check doesn't change the fruit in the tree. Community property system is a little different. That is how we deal with marriage in certain states. Community property states, they're called. And there's like 7 or 8 of them. Pennsylvania is not one of them. California, I believe, is one. Texas might be, or Nevada. I don't know all 7 off the top of my head, but they are out there. And basically, in these states, they assume that the income of one spouse is split between the two. If they own the asset during marriage, if it's a marriage asset, meaning they bought it while they were married, or the work is performed while they're married. So normally, married individuals do a married filing joint tax return. But if they have a married filing separate tax return in a community property state, it may be, a tax preparer really needs to see how to split that income. In Pennsylvania, whoever earns it, that's their money. So again, there's the assignment of income that we talked about. So to shift the income from property to another person, a taxpayer must also transfer the ownership in the property to the other person. And that's what we were just talking about. Community property system, again, 9 states have it. And half of the income earned from services of one is included in the gross income of the other in those states. Half of the income from property held as community property while they were married is included in the gross income of each spouse. Property that spouse brings into a marriage is treated separate, so it gets kind of complex. We just want to make you aware of it. I've never worked on a tax return from a community property state. Income from services. Income from services is what we call earned income. So it's your labor that produced the income, and this is a common source of gross income. So this is wages, your salaries, whatever, commissions, bonuses, your profits from your sole proprietorship or partnership. These are considered earned income. Income produced from property you own is considered unearned income. You didn't put your efforts into it, you just own the asset. So the typical type of income from these types of properties are gains or losses from the sale of the property, dividends from the property, interest, rents, royalties, and annuities. So now we're going to start talking about specific items that are either totally excluded from income, partially included in income, or included. And an annuity is an example of a partially included item of income. We've got to make sure we understand what an annuity is. People generally think of these as retirements, and that's generally when people do take them. But this is an investment that a person makes. So they pay something up front to be given money, a stream of equal payments, so the same amount of payments over a certain period of time. So that's generally what an annuity is. So it could happen at retirement. The tax law says a portion of each of your annuity payment is considered a non-taxable return of capital. Remember what you had to do up front. You had to pay in to have the right to these streams of money over time. So the part that you pay in, is not taxed. But what the tax law does is says, we'll take a portion of that and subtract it from each payment to determine how much of your payment is included in gross income. And we're going to run through an example. But taxpayers use a special annuity exclusion ratio to determine this return of capital, the non-taxable portion of their payment. So the annuity exclusion ratio is found by taking what you originally invested. What did you give up front to have the right to the future cash stream? And then you divide that by the expected value you'll get from the annuity. How many payments and what's the dollar amount of your payment? That's the expected, what we call return. It's that percentage of each payment that is considered a return of capital to the taxpayer. Here's an example. Graham purchased an annuity for $99,000 in January. So took $99,000 cash of her own money, purchased this annuity. What did she buy? She bought an annuity that will pay her $10,000 per year for the next 15 years. How much of each $10,000 payment should Graham include in her gross income? So generally, we would say, well, the first $99,000 should not be included because that's what she paid for it. But that's not what the IRS says. The IRS says no, a portion of each of her payments will be considered a return of capital. So take what she paid for it, $99,000, divided by the amount she's expected to receive. Well, this is a fixed amount. 15 years, $10,000 a year. So 66% of each of her payments is considered a return of capital, or $6,600 of the $10,000. So it's the difference, or the remaining $3,400 that she would pay tax on, would be included in her gross income. Now, some annuities are set up that they say you'll receive $10,000 a year for the rest of your life. Well, how long are you going to live? Because you need to determine how much am I going to receive from this annuity, just like Graham did with her $150,000. The IRS has life expectancy tables. So if you are 67 when you start receiving this annuity, they'll be able to tell you the best estimate of how much you'll receive over the remaining, or how long you will live and receive the money, to calculate that denominator in the exclusion ratio. Let me just double check. And these are on the IRS's website. I can't remember off the top of my head. I haven't looked at it. If they're in here. Yes, there's one on page 5-12. So if you're 68 when you start receiving your annuity, they'll say, well, you could expect to receive your annuity for 17.6 years. Graham received hers for a fixed, that was in her contract. You'll receive $10,000 for 15 years. Here, when it's for the rest of your life, you need to determine those years. 17.6 would be used in that calculation. Okay. Property dispositions. We talked a little bit about this. Taxpayers usually realize a gain or loss when they're disposing of an asset. That's true. You're either going to sell it for a gain or sell it for a loss. What we do is we say, what are the sale proceeds? We subtract then any special expenses related to the sale, like commissions you might have had to pay. That will then give you your amount realized. You then subtract from that your tax basis. It's generally what you pay for the asset, but there could be some adjustments to that. So what's your investment in the asset? How much did you pay for it? Subtract that from how much you sold it for, less selling expenses, what we call the amount realized. And the difference, if it's positive, it's called a gain on sale. You made more money than you originally invested. If it's negative, you have a loss on the sale. Okay, other sources of income. Income other than wages or business and property. Typically, these come from flow-through entities. What is a flow-through entity? Partnerships and S corporations. A partnership is a business that has owners, partners, Okay. A partnership is required to create its own tax return. It's called the 1065. And you could look that up on the IRS's website. The 1065 is what we call an information return. What happens is the partnership reports its business activity on it, profit and loss. But the partnership does not pay income taxes on the partnership profits. Instead, they divide the profits up among the owners according to whatever they have decided legally, and each partner gets what's called a K1 from the partnership, reporting that partner's respective share of profit or loss from the business. The partner then takes that information and includes that in their gross income on their personal tax return, on their 1040. So the profits flow through the entity and to the owners. The owner only pays income tax on the profits. Then when the owner takes money out of the partnership, which is generally the profits, they've already paid taxes on this money, so they could take it out tax-free. S corporations work the same exact way. S corporations are small corporations. They are what we call a tax vehicle. They're a corporation with a special tax status. Most corporations file their own tax returns and pay taxes at the corporate level. So there's corporate taxes. An S corporation does not work this way. It works a lot like a partnership. So these are generally smaller corporations. I think the requirement is that you have less than 500 shareholders. You're not traded on a stock exchange. Your assets are less than, I think it's 25 or $50 million. So they're smaller, medium-sized companies that are basically becoming incorporated to protect them from liability. The owners are being protected from liability. So most of these owners will be taking the profits out of the business when they feel like it. They're privately owned companies. And for some of them, that's how they survive. It's taking the money out of the business. The only reason they're incorporated is so that they don't get sued personally. So what the federal and state governments have decided is to make this special S corporation status. If you meet those qualifications, ask us permission, we'll grant you this status. The S corporation then files its own tax return, reporting profits just like the partnership to the IRS. That's all they're doing. The corporation does not pay corporate taxes. It then divides the profit or loss up amongst the shareholders of the S corporation and reports each shareholder's profit or loss on their own K1. The owner then takes the K1, and when they're preparing their personal tax return, they put their share of the profits in their gross income, and then they pay the income tax on it. Then when they take the money out of the business, because they're taking the profits out, it's tax-free. So they work the same. It's just two different types of business entities. That's what we mean by flow through. Alimony. For tax purposes, alimony is the following: a transfer of cash made under a written separation agreement or divorce decree. The separation or divorce decree does not designate the payment as non-alimony. So nowhere does it say this is not alimony. It doesn't have to say it's alimony, but it cannot say it's non-alimony. In the case of legally separated taxpayers under a separation or divorce decree, the spouses do not live together when the payment is made. I don't know why you would want to do that, but hey, who am I, right? And finally, the payments cannot continue after the death of the recipient. So anybody could call whatever they want alimony, but this is how tax law defines alimony. It's cash. It can only be in cash. It's under a separation or divorce decree recognized by the courts. The taxpayers are not living together when the payments are made, and it doesn't continue after the death of the recipient. Now you have alimony. How is alimony handled? Well, before or divorces that are effective before 2019, any alimony received is included in income. Any alimony paid can be deducted for AGI by the taxpayer. So let me give you the numbers for that on your 1040, because it is the 1040. So if the divorce is finalized before January 1, 2019. Alimony received would go on line 11. Alimony paid goes on line 31A. For divorce or separation agreements executed after 2018, alimony is not taxable, so you don't include it on your tax return, and the recipient doesn't deduct it. It's ignored. Now, it's very important that we separate alimony from property settlements, from child support for those divorces before 2019. Property divisions are just that. They're separating out the property amongst the spouses when they're divorced. Even if there's cash involved, that could be considered a property settlement. They are non-taxable events. They're not considered alimony, and there's no tax consequences to either party. Child support payments. These are not taxable by the recipient, nor are they deductible by the payer. Okay, so they're basically ignored for tax purposes, and soon alimony will be too. Prizes and awards. These are excluded only if made for scientific, literary, or charitable achievement, and it's immediately transferred to a qualified charity. I mean, the check is made out to the qualified charity. It doesn't even come to the recipient. So I won the Nobel Peace Prize. I tell the people down at the Nobel Committee, don't even write me a check, write it right out to the American Cancer Society. That would be excluded from my income. Prizes and awards for employee length of service or safety achievements. Only property is excluded, and it has to be $400 or less, the value of that property. Any property you receive higher than $400, you're generally taxed as an employee. And to Team USA athletes from the U.S. Olympic Committee on account of their competition in Olympic and Paralympic Games. So prizes and awards they receive. Other than that, everything else is taxable. You go on Jeopardy and you win, all taxable income. You go on Survivor and you win $1 million, taxable income. Social Security benefits. Up to 85% of Social Security benefits received could be included in someone's gross income, never 100%. And sometimes none of it is. How would we determine this? The first step is calculating what we call modified adjusted gross income. What is that? Well, it's your regular gross income. Okay, regular gross income off your tax return, line like 31, plus tax-exempt interest income. That doesn't mean it's now taxable. It's just added to your AGI. Okay. Any foreign income that you were allowed to exclude from AGI, and we'll talk about that. Okay. Generally, those are two things are added back to your AGI, and we get what's called modified AGI. So we're not changing anything on the tax return. We're just trying to determine how much of Social Security is taxed. What we then do is we take modified AGI and add to it 50% of the Social Security received. If that total is less than or equal to $25,000 if you're single, $34,000 if you're married filing joint, then none of the Social Security benefits are included in income. Zero. If that result is less than $25,000, and it falls in this range, I'm sorry, the married filing joint was $32,000. Sorry about that. In number two, if the range is $25,000 to $34,000, so that computation, modified adjusted gross income, is between those two ranges. Taxable Social Security benefits are found by taking the lesser of two computations. So you have to do two computations, compare them. The lower amount is the taxable amount. 50% of the Social Security benefit received. That's one computation. Or 50% of modified, the first modified adjusted gross income, or what we call MAGI, modified adjusted gross income, plus 50% of Social Security benefits minus the lower end of the range, which was 25,000. That difference, take 50% of, and that is compared to your first computation, and it's the lesser of the two. Now, what if your modified AGI plus 50% of Social Security benefits, excuse me, all done? Thanks, honey. See you next week. Sorry about that. I'm at my office and I had a student. Okay, so what if that modified AGI plus 50% of Social Security benefits is greater than the upper end of the range, the 34,000 as a single individual? Well, now you got a more complex computation, and here it is. It's the lesser of A or B, A being 85% of Social Security benefits. B has more computations in it. It's 85% of the difference. Modified AGI plus 50% of Social Security is above that higher end of the range of 34,000. So take 85% of that. Plus the lesser of $4,500 or 50% of Social Security benefits. So once you get that whole computation for B compared to A, the lower of those two amounts is what's taxable. So maybe you could see here, as you make more money, more Social Security, as your income is higher, more Social Security benefits are taxable, but never 100%. I'm going to talk just a little bit about imputed interest, but I want to show you one or two examples of this Social Security. I just have to grab my glasses. I thought I had them out. Okay, let's take a look. On page 5-18, let's take a look at some of these examples, make sense of them. Example 5-18, Graham received $7,200 of Social Security benefits this year. Suppose that Graham's modified AGI is $16,000. So she took her AGI plus tax-exempt interest income plus any foreign income she was able to exclude by law and legally did. So her modified adjusted gross income is $16,000. What amount of Social Security benefits must Graham include in her gross income? Well, first, let's see. We take modified adjusted gross income, $16,000, plus 1/2 of Social Security. Half of Social Security was $7,200 times 50%, which would be $3,600. Add those two together. $19,600 is compared to the lower end of the range, $25,000. So her computation there is less than $25,000. None of her Social Security benefits would be included. So we would ignore that $7,200 for tax purposes. Now let's change this. What if she still receives $7,200, but now her modified adjusted gross income, I'm going to go down to the third one, the third what if. Her modified adjusted gross income is $26,400. What amount of benefits must Graham include in her gross income? Well, Graham is single, and her modified AGI plus 1/2 of Social Security would be $7,200, $3,600 plus $26,400. $26,400 being her modified adjusted gross income plus $3,600, 1/2 of Social Security, or $30,000. So now she's above that $25,000 lower end of the range, but not above the $34,000. So now we take that second rule and we say, okay, how much of her Social Security is taxed? Well, it's the lesser of two things. 50% of her Social Security benefit, which was $3,600, or 50% of the amount her modified adjusted gross income plus 50% of Social Security, the $30,000, is above the lower end of the range, $5,000 times 50%. Don't forget to multiply that difference by 50%. So the B computation equals 2,500. Her A computation is 3,600. The lesser of the two, $2,500. So now of the $7,200 in Social Security, she includes $2,500 of it. Finally, assume that Graham received, this is top of page 5-19, the $7,200 in Social Security benefits, and now her modified adjusted gross income is $31,400. So we take the $31,400 plus $3,600, 1/2 of Social Security, $35,000. Now that computation is above the $34,000 higher range. So we use that last crazy formula, and we'll take this step by step. Her Social Security benefits that will be taxed are the lesser of 85% of Social Security. So take 7,200 times 0.85, 6,120. Or 85%, the amount her modified adjusted gross income plus 50% of Social Security is above the upper range. So we had the 35,000, which was her modified adjusted gross income plus 3,600, 1/2 of Social Security, minus 34,000 is 1,000 times 0.85. Add to that the lesser of $4,500, which is just an amount they give us, or 50% of Social Security benefits. Well, 50% of Social Security benefits is the lesser amount, 3,600. So the answer to B is 4,450. So the answer to A, 85% of Social Security was 6,120. The answer to B, 4,450. The lesser of the two is what is included in taxable income or in gross income. Okay, so I know those formulas get kind of crazy, but those are just the rules. Now, if they're married, you would go through the same scenario. You would combine their Social Security. So this is for married filing jointly. If both receive Social Security, you would combine them. If only one, you would just use the one. And you would follow the same scenario, but now your ranges go from 32,000 to 44,000 instead of from 25 to 34. Okay? The next item, imputed income. Certain employee discounts or low interest loans generate income via indirect benefits. Why? Because you're not being charged for the normal interest rates. So you're actually gaining money because you're not being charged enough in interest. Well, what the IRS may do is come in and say, what interest rate should you have been charged? They look at the federal interest rate compared to the interest rate you're actually being charged, and the difference they will include in income. That is imputed income. You may not receive it, but you're going to pay tax on it. And in that, I don't focus a lot of time on this, but you can read about it on 519. So basically, the borrower is deemed to pay imputed interest, and then the lender is deemed to have returned the imputed amount. So imputed interest rules do not apply, though, to loans of $10,000 or less between the lender and borrower. So if you're in a small family loan situation, you borrowed in total $10,000 or less, they don't even look at that. But it's for more significant. And what they're looking at here are loans between really businesses and their owners or related parties there, members of the family. Okay, discharge of indebtedness. When a taxpayer's debt is forgiven by a lender, so if you owe a lot on your credit card and you ask your credit card company to forgive or reduce the amount you owe them, that is discharge of indebtedness. Now, certain loans, let me back up. Normally, the amount of discharge of indebtedness is included in gross income. There are certain times and certain types of loans that you don't have to include it. But generally, that's the rule. If you are considered an insolvent taxpayer, so your liabilities exceed your assets, then a discharge of indebtedness is not taxable. If the discharge makes the taxpayer solvent, meaning now your assets are greater than your liabilities, the part that makes you solvent is included in income. Take a look at page 5-21. Courtney borrowed $100,000 from EWD. Because EWD wants to keep Courtney as an employee, it agreed to forgive $10,000 of the loan at the end of each year that Courtney stays on board. On December 31st this year, EWD formally cancels $10,000 of Courtney's indebtedness. How much of this relief is Courtney required to include in gross income? All $10,000. Okay, I had a client, she had credit card indebtedness forgiven. I think it was like $1,500. We had to include that in her tax return as gross income. And really, where do you put it? Line 21, other, because there is no line for it. Now, as we said, there's certain areas, so we talked about some items that are partially included, partially excluded. There's some exceptions. Congress allows certain type of income to be excluded or deferred. Municipal interest, we saw this already. Bonds issued by state and local governments, including school districts, located in the U.S. So if a taxpayer buys a bond, basically a bond is just the taxpayer loaning the government money. The government's going to pay them interest over the term of the bond, and then at the end pay the money back to the person, the taxpayer. Well, interest income on these bonds over the life of the bond is tax exempt, meaning you don't pay income tax on them. You report them on your tax return on line 8B. You've got to report the dollar amount, but you do not include it in your gross income. Gains on the sale of personal residence. Again, when you sell your personal residence, and we normally sell them for gains because they go up in value. So we look and say, how much should we sell it for? Less any selling expenses. How much should we pay for it? And generally, if we made major improvements, we would add that. And the difference is the gain or the loss. Losses are ignored, but gains could be taxed. But the rule is you can exclude up to $250,000 of gain, $500,000 married filing joint, if you've owned the property for, I think, 2 or 5 years and you use it. You've used it in the last 2 years as your personal residence. 2 or 5 years you've used it as a personal residence. At least 2. Now, if your gain is above these exclusion amounts, it's taxed as a long-term, and we talked about this, long-term capital gain. So it has special tax rates. Fringe benefits, page 5-24, and I think we come back to these also again, if I'm remembering correctly, in another chapter. But certain fringe benefits an employer gives to an employee are tax exempt. Some are taxable. They're called qualifying fringe benefits. And what do they include? Medical, dental, and health insurance premiums, life insurance premiums, and small benefits, de minimis we call them. On page 5-24, there's detailed examples, and I just want to run through some of these. An employee may exclude from income the cost of medical insurance coverage premiums paid by an employer, so they're not taxed. And then proceeds, because you used the insurance policy, not taxed. Life insurance coverage, so the premiums related to the first $50,000 of life insurance coverage are tax-free. But if your employer pays for a life insurance policy on you that's value is more than $50,000, some of the premiums are taxed or included in gross income. De minimis, small, who cares, little benefits like that ham you receive or using the copy machine at work, not included. Oh, here we go. I didn't realize that was there. So, yeah, I love PowerPoint sometimes. If you are given meals by your employer, basically to keep you on site during lunch, okay, or your break, the value of the meals are excluded from gross income. The other is that for lodging, it's a requirement of employment that you take the employer lodging. The value of the lodging is not included in income. Employee educational programs, employers can reimburse up to $5,250 of education-related expenses of an employee, non-taxable to the employee. Qualified employee discounts. Discounts less than 20% are excluded. If it's a on services, if it's a product, the employee cannot have a discount that would make them pay less than the cost of the item. So if you work at Best Buy and you get a TV for a special price of $1,000, everybody else is paying $1,300. The cost of the TV is $800. Well, you paid at least the cost, the $800. So that discount is not taxable to you, that $300 difference. But if you paid less than $800, the portion you paid that's less than $800 would be included in your income. Dependent care benefits. Employees may exclude up to $5,000 of reimbursement from their employer for dependent benefits. Working condition fringe benefits, and you could read through those. Qualified transportation benefits, basically saying that you can exclude from income certain transportation expenses reimbursed by an employer, and those are going away. Don't think they went away in 2018, but they're on their way. So read through that list. If you have any questions, make sure you ask them. Education-related exclusions. Scholarships. So when you receive a scholarship for academics, not included. Tuition, fees, books, and supplies, excluded. But if it's paying for room and board, that portion of the scholarship is included in income. The exclusion applies only if the recipient is not required to perform services in exchange for receiving the scholarship. Taxpayers are allowed to exclude from gross income earnings on investments in qualified education plans, like a 529 plan. I know myself, I say for my son's college, and it has earnings on it. So when he takes that money out, as long as he uses it for school, it will be non-taxable, even the earnings. Some taxpayers can exclude interest on U.S. savings bonds if the proceeds of the bond are used to pay for higher education expenses. Gifts and inheritances. So gifts and inheritances are generally not taxable to the recipient. Life insurance proceeds. Amounts received due to the death of the insured are excluded from the recipients. So if it's a life insurance policy that is being used as it should, or it's occurring as it should, the person dies, the beneficiary receives the income, non-taxable. If the proceeds, though, are paid over time to the recipient, and there's part of the proceeds that they're receiving over time have an earnings component, that will be taxed. The earnings component is taxed. You generally don't get an exclusion if a life insurance policy is transferred to another party for valuable consideration, or the taxpayer cancels the life insurance policy and receives proceeds in excess of the amount they paid in. So when that happens, the person receiving the money has to look at what they paid for, what was put into it, and then the excess is what is taxed. Take a look on page 5-29. I think, no, that's not what I want. 5-28. Grant receives $200,000 of accelerated death benefits from a life insurance policy last year. This is different. When he was diagnosed with cancer, he's expected to live for less than 1 year. That's what our last statement says. Exclusions are available for accelerated death benefits. So what this means is if somebody is diagnosed with a terminal illness, they'll be passing away within the next 2 years, according to the best statistics, or they're chronically ill, and they take their life insurance policy out early. Terminally ill can spend it on anything and have no tax ramifications. Chronically ill have to use it to pay for their care in order for it to be non-taxable. So in Graham's case, if he takes that out, none of it is taxable. Due to financial issues in the next scenario, several years ago, Gramps transferred a $100,000 life insurance policy on his life to a business associate, giving him $5,000. So Gramps got $5,000. He gave the business associate the life insurance policy. Since that time, the business associate has continued to pay the annual premiums on Gramps' life. They total $20,000. When Gramps dies and the business associate gets the $100,000 policy, some of it is taxable. How much? The $100,000, what he received, minus the $5,000 he originally paid Gramps for it, minus the $20,000 in additional premiums that the business associate paid. So business associate beneficiary now has a $75,000 ordinary income. Foreign earned income. A maximum of $103,900 of foreign earned income can be excluded from gross income for qualifying individuals. And on page 528 to 529, they talk about determining that. You need to be considered a resident of the foreign country by living in the country for the entire year, or live in the foreign country for 330 days in a consecutive 12-month period. Okay, so if you meet those two requirements, you may exclude up to $103,900 of your foreign earned income. They do this to prevent double taxation on individuals who work in foreign countries. Because remember, U.S. citizens must report their income on a 1040. No matter where you live, they may also be paying tax to the foreign government that they live, the country they live in. And that's what I was just saying about the requirements. Here's an example. Courtney's considering a transfer to overseas affiliate, which should be paid $120,000, assuming her 12-month qualifying period only includes 200 days in the first year, 140 in the second. How much of her expected salary in the first year can Courtney exclude? Well, up to $103,900 times 200 days over the 365. She meets the requirements, 200 plus 140. She'll have 330. It's just that they span over 2 years, so we only could allow her 200 days for the years she lived and made up to that full exclusion.